Hello, everyone. Yeah, welcome to FOMC. Long time no see. I think this is a good time to be back. Going into a bit more, streaming. Dollar index has made a bit of a bottom around 107, 100.70. We're now at 103. I'm expecting dollar to continue rising today. Why is it looking at my belly? Okay. I'm expecting dollar to rise. An acknowledgement of the higher than expected CPI. PCE not really there. GDP going higher, or at least not falling as much as it should. The fundamentals are not lining up with what you would, I don't know, what you would expect for what you would expect for what do you call it in English? What you would expect for what you would expect for a rate cut. There we go. Cool. Secondly or thirdly or so, how are you guys doing? Hi, Altaf. FOMO, eagerly waiting for you to go live. Thanks for coming live. Dollar bullish, Aussie, New Zealand, silver, Nasdaq sell. I am. I agree. I agree with that. More than dollar bearish. Of course, we can't, put things into his mouth before he says it, but at least we need to double check that, that's where things is going. I just want to check the sound. If there is anyone that is here could be mentioning the sound, that would be great, just to see if everything is great and how it's supposed to be. So say Bitcoin. Isn't it fun? I can't even find my own live at the moment. Cool. Hi, Dexter. Happy to have you here. Are you here and on Twitter, Nick, or are you just here today? That would be great to know. Should we say invites? And then I'll send the invite to Mr. Joe. We can ask Joe to come. Yeah, cool. Cool. Statement. I'm a one-man show today. Sorry, I don't have any people back end. So cool. What else? What do we expect? So how did I? Well, I think my bias and how I understand the market is dollar bullish, and not that there is new information that is new information out there. I just feel like it's not. It's just an acknowledgement of the current state, and to hear Fed saying that is also, a correction, because there is pension funds and large funds that will only listen to them. Of course, they will adjust when they look at the data, but that's another, it's another confirmation of them being right or wrong. So I don't know if it's algorithm, but it's always another move by the Fed. Secondly, we have already priced in, I calculated earlier, 6 rate hikes so far this year. So if Powell pushes hard back on that and say, we are at a proper level, then that's going to be very dollar bullish. So in my mind, it's kind of like how much push does he do? And also, of course, the opposite way that he can do, and the reason why I don't, trade before I've heard him say it, is I believe he will say something in the direction of, or he can also go more bearish and more dovish and say that we are seeing that inflation is coming down. It's not going as fast as we think, but it is, closer to two than the peak. So we want, because he said, I think it was last time in December, he said that we're we're not going to start cutting interest rates when you hit 2%. They're going to cut before that. I think the current debt and funding two wars can't see how the Fed will start printing without inflation is correcting. Yeah, okay. So there is a couple of problems with that, Dexter. Is yeah, as inflation does create, wars create inflationary pressure. It because and it creates government spending, which but it's purely, and if your country is in war, which is not at the moment, as in domestically, as long as they're not in war domestically, common people won't feel the direct hit. They won't start to what do you call it? Not hamster in Norwegian. Hamstre is collect a lot of food, like like people did during 2020. Um, running out of toilet paper, so there's a surge in demand for consumer goods. I don't think that way. So where I see it, um, I see it as just people keep their jobs. We're going to be told that on Friday by NFP, but that's the key main driver uh for inflation. Why do we have inflation so much? Because people have jobs. That's the core basic of it. And then you can say, was COVID constraints, prices had go up because people couldn't deliver goods anymore, because it was sick, because it was stuck, because of all these other reasons that was there. I think that, to be honest with you, um, as long as people have elevated salaries and as long as people are employed, we're continuing to have inflation. But the moment we start losing job, the moment we can't afford the living that we have, what we are sort of able to do now is soft landing. Um, Ahmad says, "What's up? Glad to see you again. Thank you very much, Ahmad. Happy to have you here again." I think the current, monthly dollar looking very bearish. Be prepared for an upward shock against the dollar. Jimmy, I would love that. um, uh, Dexter says I sound like a Russian economist. Yeah. Okay. So I'm also not in America, but what happens? What I think is happening and will happen and should happen, is a slowly reduction. But if you see, which we are seeing, corrections in the real estate market, correction in the office lending business, if we see a correction in many industries, it's not going to be a soft landing, it's going to be a hard rock one. But being in a war with other countries like China, going to Yemen, going to Ukraine, that's going to create inflation domestically because they have to, replace this ammunition they have given them. But Americans, as Americans are, they won't feel it because it's somewhere else. It's not there in their backyard. Hello, Tito. So to be honest with you, it's kind of funny, um, more than anything else. But yeah, it is what it is, I guess. Cool. We are 28 people. We have 2 minutes left until we need to pull up or less than 2 minutes. We need to pull up the Fed FOMC the Fed FOMC kind of thing. What I'm going to do today, I'm not going to trade it as of now. I just want to see it, and kind of what I'm saying is, we have risen for quite some time in 2024 already. We are in a range, so it doesn't really matter. I think we're going to break higher, but I already feel like the move has gone, so I need to have a new high and then continuation before I can do something more. It's kind of like, JP, why you I can do that later? I can do it later. The reason for that is I can only have one thought in my brain at the same time. I'm a man. I'm a man. Yeah. Have I ever been told more than 2 things to buy at the grocery store and come back with nothing because we're told more than 2 things? Yeah, there we have it. Okay. That's just a limit of brain capacity. Nothing else. But we'll do it after after going through the statement. All right, cool. Trading forex is risky, not for proper for everyone. Past performance on the different future results. If you haven't done this before, don't do anything. Cool. It is 8 p.m. Cool. Let's update the website. Nope. Coolio. So where is it then? Yeah, so they haven't changed their interest, right? If they can only I don't know, give me like the updated version here. Thank you very much. That would be great. Chaos on my screen. Apparently not the fastest one today. Report. Let's go to report. There is the report. I have found it. Cool. There we go. Recent indicators suggest that economic activity has been expanding at solid pace. Okay. Job gains have moderated since last year, but remain strong. Unemployment rate has remained low. Inflation has eased over the past year, but remains elevated. That is great. Fed does not expect it will be appropriate to reduce rates until it gathers confidence that inflation is moving sustainably towards 2%. I said so. I said so. All right. So, is there anything I can sell now? Not really. New Zealand dollar, Euro dollar to me is like, okay, I will do it. Fine. It's just a 001 trade. I'm not gonna break the bank for it. And you're not gonna be like, man, you lost money. I don't care, bruv. This is me trading 001. Coolio. What my price? 82.44. Trading forex is not for everyone. Past performance on indicative future results. And if you don't know what you're doing, don't do it. Cool. Where are we? So sold euro dollar entry 0.8422. I can't even spell today, people. So I do apologize for that. 108.244. You're welcome. Currently 32 cents in profit. So we'll see. We'll see. It's just what do you call it in English? It's just a scalp. Don't seasonality is bullish. Yeah. So if I can hope for something, I can hope for like 109.50. So these reverse and then go back up. That would be great, and that would be a great scenario. Still remain bullish on NAS. I agree with you, sir. Um, Go back to where this thing was. Committee 6 in support of goals, it maintains 5.25 to 5.5. It considers adjustments in the target range for fund rate. Committee will carefully assess the commit data, evolving outlook, balance of risk. It is not appropriate to reduce target until it's gained greater confidence of inflation moving low, substantially below 2%. That one is a new statement from last time, and it's a punch in the face. It is a punch in the face to the ball, to all the positions that was made in December. Currently at break even. In assessing the proper sense of monetary policy, committee will continue to monitor implications of incoming information. Economic outlook committee will prepare to adjust the stance if risks emerge that could impede attain the committee goals. The committee assessment will take into account a wide range of information, including readings on labor market. That's why we're looking into it. Inflation pressure, inflation expectations, and financial market and international developments. The end. All right. Nothing too bad, too sad. Yeah. So to me, it's what it is. So that's the new sentence in there, at least bare minimum, that we need to look out for. We now have 25 minutes until the press conference. I want to see the 2-year 2 note. It drops a bit. When that's from earlier. Yeah, it rises a bit actually. It rises a bit, which is expected. It rises a bit. SPX should fall. Well, it's not that bad for S&P, Nasdaq, but it's more like S&P 500 is so high that even Snoop wouldn't have a thing. When it comes to stocks and Tesla, Mr. Sharker, and Tesla is in a great fall at the moment. The thing with Tesla, I would be a bit cautious at the moment. But to be honest with ya, I see this as a buying opportunity overall. The reason for it is that I still believe in Mr. Who? What is he called now? Elon Musk. It's still a software company, and just checking his seasonality. And we're supposed to be having a downturn now, and then going up from like February. March is going to be bad. May is going to be bad, and from May, we're going to have a very great time. So, if you look last year, okay, last year was great until February, which is opposite this year, and then the bottom was around May. So, as I said, still a buying opportunity. Why you sold the euro before the press conference? Good question. No answer. The real answer is I'm scalping it, and it has no fundamental reason or press conference reason. It's only short-term volatility. So where they put in the where they put in the what do you call it? Where they put in the new text there, the new sentence there. He's definitely going to push back on currency rate on cutting, and the current cuts before the meeting was 6. So this one should now go to, when this is updated, whenever that is. This one should go. This one should go to 100. This one should go to 0. But then the question becomes, and what we'll discuss with Powell later, is how far up is this one going to go? Currently in 375, which is 6. I think it's 6 cuts. That is going to be repriced now. And for some reason, yeah, okay. Because a month ago we were pricing in 35, like here, to be the most likely one. Now they have reduced a bit. And now this one, now this 450, 475 should become more, not necessarily entirely where we will go, but it will at least go up to 425. I think it's going to be the most likely scenario, where we push back on March, and then May may be the first time we'll cut again, or June. Those are the two options we have right now. Dexter, don't you love my reasoning? Like, it is so intellectually refreshing that you have never heard ever before. I think that I've been discussing lately the effects of new centralized digital currency in Forex, and especially Bitcoin as a parallel currency. Yeah, okay. So what I believe is going to be, what I think is going to be the case is, I think it's going to be more of higher volatility, less volatility, more volatility, and less liquidity in the forex market. So, if anything, it's going to make the market worse to trade, because the forex market, it's not going to go away as in current format currently, but I guess it's been embraced more than ever now. So, because what happens to forex market is that it just becomes very, very volatile. Cool. Altaf says JPY view now. You're very, where are we now? You're very straight on to that, mate. So, back to Japan. Opinion. Summary of opinions on monetary policy, January 22nd and 23rd. Published today. To be released today. So, Japan economy has recovered moderately and is likely to continue to do so. However, there remain extremely high uncertainties around economic activity and prices. It is necessary to closely research and analyze the impact of the earthquake on Japan's economy. The domestic economy has been resilient on the whole and continue to recover moderately. The increasing number of firms have reported that improvements in profits. They have been concerned of a labor shortage that have positive views towards wage hikes. In addition, there has been moves to resume business fixed investment plans that has been postponed due to rising material prices. With high uncertainty regarding overseas or economies, Japan's economy is currently lackluster due to somewhat weak exports and business fixed investment. However, if overseas economy recovers, the Japan economy is likely to see a clear recovery trend. Even amid price rises, the level of consumer sentiment has maintained so far, mainly due to moderate improvement in the employment and income situation, as well as the effect of the government various measures as those address rising prices. So I think that's kind of summarizes it. That's yen bearish. What it means is they're not talking about pricing rises. CPI was lower than expected last time. They are still going to continue their ultra loose monetary policy, and I am not by any means gonna change my view on yen. Only problem with yen is that we have where did we go? We have yen bullishness seasonality right now. So my view is bearishness on yen so far. We can add Joe to the mix for the next 15 minutes or so. Joe, how are you?
Doing well. Long time no see.
Long time. Okay, yeah. Merry Christmas, Happy New Year, and happy.
And I didn't forget. Happy birthday soon.
Oh, thank you very much. Actually, is it on Sunday or something?
I don't know. I got it on my phone. I'm like, I got
It's
notification like
actually on
Fred's
Sunday. Yeah.
birthday. Like, oh shit, we need to do something for him, guys.
Oh.
We need to do something for him. We gotta
Yeah, it's
figure something out.
4th of February, people. If you guys were wondering.
Yeah. Yeah. So this was the most neutral of neutral FOMCs, huh?
Yeah. Also, the thing that the thing that I see is that of course market went super duper bearish. Like we're gonna cut the most amount of cuts in our entire life. And I think that's just that's the fun part of trading because the market goes very extreme, and then you just need to reverse your trades when you see that it doesn't go the way it's supposed to go. So it's fun to be a retail trader, I guess, if you don't understand what's going on.
Mm-hmm.
So
I'm really
yeah,
looking forward to probably the rest of this week, and I'd say the next few weeks, probably up until the middle of February now. Because
yeah,
based off the expectations for this result from FOMC,
mm,
the dollar should be getting a bit stronger from here for
mm-hmm,
like another week or two. Now, if the Fed had said, oh, we are absolutely not hiking and we're not going to be hiking at least until the third quarter, potentially. If they just flat out gave a timetable, that would have impacted the market much more negatively, made the dollar much more strong in magnitude move. But because they didn't give a time frame, they said they're still data dependent. They're not trying to reach cuts by a specific time.
you said hikes though.
Well, you know what? The January inflation data and the February inflation data still have to come out. And when it all comes out,
Mm.
it's probably not going to move the Fed significantly enough come the March meeting. I just got a notification from Financial Juiced. It says first Fed rate cut in March versus May is now priced at about even odds based on the rate of futures pricing for the cash rate. And
That was
previously,
earlier.
March had been much more likely. It wasn't even. So now it seems like post FOMC, you have
It
to,
looked
yeah,
pretty even to me though.
the CME futures updates at a different frequency than the futures market. The futures market is already moving.
Yeah. My point
Yeah,
was this is kind of pre F1 pre
yeah,
the segment, and it roughly was a bit more even earlier today. But
yeah.
okay.
So I just think the net impact is it's. I mean, once we get the January inflation numbers out, we'll have
Mm,
a fair. If so long that number isn't super volatile, uh, from the prior number or from forecast expectations,
yeah.
we should have a pretty linear disinflationary trend. And
Yeah, as long
the
as it
question
continues lower, yeah.
for, yeah, and then the question for risk on or risk off becomes less about is the inflation growth metrics in the United States doing particularly fantastic, but what's the relative performance for all the rest of the G10 and the G7? Because if you have a very steady rate of disinflation in the United States that's
Mm,
predictable, other countries can try and achieve different economic goals for their own currency, for foreign relations and foreign exchange purposes, uh, based off that predictability in the trend of inflation. So, if one country really wanted to have a more attractive currency rate, they
mm,
could try and either have greater disinflation or better growth, and at least they would know what to target, frankly. And I don't know about
mm.
what's going to happen with New Zealand and Australia because I don't know if you have any commentary on China now, but that's pretty nutty.
That's a nutcase and a half. I wanted to comment about Trump though.
All right.
Um, it's a joke, by the way. No, what I saw. What did I see the other day? That they have probably 100% chance of a rate cut in Europe in March, and the Australian wasn't. It's not doing too great either. They also are likely going to join the rate cut team soon. Um,
It's really
and but
bad in
their inflation
Australia right
was
now.
that was Chris Weston, I think. But that they are inflation are around 4%, 4.2. So that's still very high as far as I remember. But yeah, might be wrong about that. Yeah, that's what I remember. I might be wrong. But yeah, so it's pretty bearish across the board. China have nothing. Well, other than I only have the tabloids from China, which is Evergrande, that was bankrupted yesterday or the other day.
I mean, yeah, the Chinese government stepping in to save their butts.
Yeah, yeah.
They keep
But
stimulating their economy, and you know what? It's working. It's keeping them alive, um, and quite a bit of their more and more debt is getting for their own country is getting denominated in yuan, so it's kind of helping them get through some of their financial struggles. It's really
mm,
just a question of can they keep doing that with countries that are like unequivocally aligned with the United States? Can they keep borrowing that until like Australia or New Zealand says, no more? The Philippines is more China leaning, but at some point, even the Philippines would be like, you're printing so much money, we'll just, yeah, we'll still work with the Japanese if that's what it takes.
yeah. Uh, Also, am I worried about China being pumped up so badly with debt that a bubble's gonna burst over there? It's kind of like the only way. It's like the deadliest catch or uh, pest or cholera, where they have two evils to choose between. Like they don't have growth or they didn't have growth, and they're trying to create growth. And the only way to create growth is, has at least been the solution to borrow a boatload of money. But then the problem is that it has been too much too fast, which was probably necessary anyways. And then now they just build massive amounts of real estate that nobody buys and or nobody are are renting. So
Yeah,
it's
I'd
it
say
it,
like
it yeah.
net net, it's definitely China's definitely going to be a longer term story. Like it's gonna, you might want to call it a gray swan if something bad happens, but just as bad as things are right now in China, things can still get better from here. Um,
Hmm.
at least from the United States side, because a lot of people are talking like, oh, India is going to replace China as far as the cheap labor population stuff goes.
Hmm.
So I don't know. China doesn't make like really cheap knickknacks anymore. They have some
Hmm.
really the quality of stuff out of China keeps getting better and better and better. So maybe we'll see their economy bounce back, and who knows, maybe it outcompetes Japan. I mean, we'll see. But it's kind of in this transition period where they have a lot of really good product, and it's just a matter of now can they scale to doing more advanced things on their
Hmm.
own without,
Hmm.
because there's a lot more people in the world that are not so friendly with China anymore. Not a lot of uh, some countries aren't, especially African countries, aren't totally in love with Xi Jinping.
It's a love-hate relationship, to be honest with you. So, for that matter, Europe as well, which is the biggest debt holder. But right now, with emerging markets, you are facing more and more countries are facing a bankruptcy or or huge economic hardship, while having to pay back whatever gazillions amount of dollars they have borrowed, and the now it's time to pay. And if you see the Kenny shillings, for example, it is absolutely tanking, like a stone, or a knife going through a knife going through butter. Yeah, we have peaked at 163. It was 100, what, 2 years ago or so. Um, so so yes, China has invested a lot in Africa, has invested a lot in Kenya. Um, they get to use their, I don't know, their money to get returns. And I don't know if it's an ideology war or whatever, but now it's time to start paying, their installments, and they are definitely struggling to do that. Dexter says Republican have seen China as a problem, but Democrats sees Russia as a problem. Um, to be honest with you, Dexter, none of this is true, or none of them is actually the problem. I don't know if America is the first one to blame everybody else, but if you blame China, if you blame Russia, then you are the problem yourself. So
Well, it's January 31st, and tomorrow is February 1st, which means we'll be in a new trading month. Do we have any forecasts for the month ahead?
do you, do you feel butthurt or something?
No, my man. We got any forecasts for the month ahead? It's just, we can only talk about geopolitics for so long before, people kind of start getting bored
Okay,
of
all
it, because
right, okay, okay, all right.
not everyone can interpret the geopolitics stuff, and actually a lot of it's kind of still up in the air. A lot of
Okay,
countries kind of like to keep their cards close during a U.S. presidential election year. They want to see what the U.S. is going to do first before they make their next move.
yeah. Let's give them the summary. The summary is, if China goes down, Australia, New Zealand, and Europe will struggle. And America will benefit from it. Um, Russia is already kicked out of the market anyways, and we can't trade it. So politically wise, that's just political. Trading wise, Russia is doing Russia things, and what Russia is doing is already priced into the market. When it comes to Trump, that's going to be the bullish if he wins, and whoever's going to be other candidates, that's going to be the bearish. That's kind of the rule of thumb unless the Democrats find a crazy one. I don't know who that's going to be, but anywho. The forecast that I have on my books is dollar strength in February, from third, at least on a euro dollar, from 3rd of February to 23rd. That's euro dollar and euro Aussie. We have already not priced in already, but we have euro coming in with a rate cut next time in March, I think it is. So this one is definitely down, but if dollar does the same, which it doesn't, this one would go higher. So if dollar does increase or stay high, this one is likely to continue lower.
For euro dollar, I absolutely agree. As far as the timing for the seasonality goes, when it comes down to the pricing, that can be a bit sketchy to figure out the pricing, because either you're talking like the mid 106s as a target, or somewhere much closer, like just in the 20 or 50 pips below 108 here, as far as
Yeah.
finding a low for February on euro
Mm.
dollar. So it really depends on the volatility expectations. I'd say that if the January inflation for the United States doesn't come out nice and linear and at or below the forecast, right? If inflation does not continue disinflating,
Mm.
see, it's going to be interesting where CPI. I have a mind game here. CPI comes out lower in the U.S., yet that makes the U.S. dollar get weaker, not
Mm.
because of some weird economic thing. Because typically, when people do textbook analysis of a currency, this country's inflation is disinflating. That currency should therefore be getting stronger because their inflation is getting lower. So that currency must be getting stronger. Not so much in this situation with the US dollar, because the currency's strength today is not indicative of the currency's price tomorrow. Specifically because when that inflation print comes out disinflationary, if it does, and it comes out nominal. Oh, is it Powell's time
Remain
now?
squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. The economy has made good progress toward our dual mandate objectives. Inflation has eased from its highs without a significant increase in unemployment. That's very good news. But inflation is still too high. Ongoing progress in bringing it down is not assured, and the path forward is uncertain. I want to assure the American people that we are fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Over the past 2 years, we have significantly tightened the stance of monetary policy. Our strong actions have moved our policy rate well into restrictive territory, and we've been seeing the effects on economic activity and inflation. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are moving into better balance. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a solid pace. GDP growth in the fourth quarter of last year came in at 3.3%. For 2023 as a whole, GDP expanded at 3.1%, bolstered by strong consumer demand as well as improving supply conditions. Activity in the housing sector was subdued over the past year, largely reflecting high mortgage rates. High interest rates also appear to have been weighing on business fixed investment. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 165,000 jobs per month, a pace that is well below that seen a year ago, but still strong. The unemployment rate remains low at 3.7%. Strong job creation has been accompanied by an increase in the supply of workers. The labor force participation rate has moved up on balance over the past year, particularly for individuals aged 25 to 54 years, and immigration has returned to pre-pandemic levels. Nominal wage growth has been easing and job vacancies have declined. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. Inflation has eased notably over the past year, but remains above our longer run goal of 2%. Total PCE prices rose 2.6% over the 12 months ending in December. Excluding the volatile food and energy categories, core PCE prices rose 2.9%. The lower inflation readings over the second half of last year are welcome, but we will need to see continuing evidence to build confidence that inflation is moving down sustainably toward our goal. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. Over the past 2 years, we have raised our policy rate by 5.25 percentage points, and we've decreased our securities holdings by more than $1.3 trillion. Our restrictive stance of monetary policy is putting downward pressure on economic activity and inflation. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25 to 5.5%, and to continue the process of significantly reducing our securities holdings. We believe that our policy rate is likely at its peak for this tightening cycle, and that if the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year. But the economy has surprised forecasters in many ways since the pandemic, and ongoing progress toward our 2% inflation objective is not assured. The economic outlook is uncertain, and we remain highly attentive to inflation risks. We are prepared to maintain the current target range for the federal funds rate for longer, if appropriate. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are moving into better balance. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we've seen on inflation and ultimately require even tighter policy to get inflation back to 2%. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess the incoming data, the evolving outlook, and the balance of risks. The committee does not expect that it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably toward 2%. We will continue to make our decisions meeting by meeting. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our questions.
It's kind of like somewhere in the middle. Not really bullish, not really bearish, not really dovish, not really hawkish. He's pointing so far, at least, the current situation to the T, where you have 3.4% inflation, which is lower than the peak, but it's not as low as they want. It's a bit higher than they wanted. But he did not mention anything about the volatility or that, But he said that we are likely at our peak, and if the economy evolves as expected, we can dial back policy this year, but not now.
From the New York Times. Thanks for taking our questions. Obviously, in the statement and just in your remarks there, you note that you don't want to cut interest rates without greater confidence that inflation is coming down fully. I wonder, what do you need to see at this point to gain that confidence? And as you make those decisions, how are you weighing recent strong growth in consumer spending data against the sort of solid inflation progress you've been seeing?
Sorry, say that last part again.
How are you weighing the growth data and consumption data, which have been surprisingly strong, against inflation data?
Okay. So what are we looking for to get greater confidence?
Good question.
Let me say that we have confidence. We're looking for greater confidence that inflation is moving sustainably down to 2%. Implicitly, we do have confidence and has been increasing, but we want to get greater confidence. What do we want to see? We want to see more good data. It's not that we're looking for better data. We're looking at continuation of the good data that we've been seeing. And a good example is inflation. So we have 6 months of good inflation data. The question really is, that 6 months of good inflation data, is it sending us a true signal that we are in fact on a path, sustainable path down to 2% inflation? That's the question. And the answer will come from some more data that's also good data. It's not that the 6 month data isn't low enough. It is. It's just a question of, can we take that with confidence that we're moving sustainably down to 2%? That's really what we're thinking about. In terms of growth, we've had strong growth. I mean, if you take a step back, we've had strong growth, very strong growth last year, going right into the fourth quarter. And yet we've had a very strong labor market, and we've had inflation coming down. So I think, whereas a year ago we were thinking that we needed to see some softening in economic activity, that hasn't been the case. So I think we look.
This is actually a change. Last time he said that he was more into like where we are going. Like we had done a good job going down on inflation, yada yada yada. Today he is more like we need to see good data. So now he's dialing back on that the good data we have seen. So it's no longer yeah, we were, but now it's 3.4. So he's actually dialing back on the dovish commentary, actually, as far as I can see it.
We look at stronger growth. We don't look at it as a problem. I think at this point we want to see strong growth. We want to see a strong labor market. We're not looking for a weaker labor market. We're looking for inflation to continue to come down as it has been coming down for the last 6 months.
And I'm sorry, if I could just follow up very quickly. When you say that you want to make sure that it's a true signal, is there anything that you're seeing in the data that makes you doubt that it's a true signal at this stage?
No, I think I would say it seems to be the likely case that we will achieve that confidence, but we have to achieve it, but you can, and you know this, you can look behind those numbers and you can see that a lot of it's been coming from goods inflation, for example, and goods inflation running significantly negative. It's a reasonable assumption that over time, goods inflation will flatten out, probably approximate zero. That would mean the services sectors would have to contribute more. So in other words, what we care about is the aggregate number, not so much the composition, but we just need to see more. That's where we are, and that tells a path down to 2.
Nick Timros of the Wall Street Journal. Chair Powell, it seems to me you raised rates rapidly over the last 2 years for 2 reasons. One was the risk of a wage price spiral. 2, there were risks of inflation expectations becoming unanchored. This morning's ECI report for the fourth quarter shows private sector payroll growth running at a sub 4% pace. Inflation expectations are very close to where they were before the inflation emergency of the last 3 years. And given that you appear to have substantially cut off these 2 tail risks, and that you've judged here today current policy is well into restrictive territory, what good reason is there to keep policy rates above 5%? Are you really going to learn more waiting 6 weeks versus 3 months from now that you have avoided those 2 risks?
So, as you know, almost every participant on the committee does believe that it will be appropriate to reduce rates. And for partly for the reasons that you say, we feel like inflation is coming down. Growth has been strong. The labor market is strong. What we're trying to do is identify a place where we're really confident about inflation getting back down to 2%. So overall, I think people do believe, and as you know, the median participant wrote down 3 rate cuts this year. But I think to get to that place where we feel comfortable starting the process, we need some confirmation that inflation is in fact coming down.
Higher than the levels recommended by those rules in the current instance?
Well, look, I think, as you know, we consult a range of Taylor rules and non-Taylor kind of rules. We consult them regularly. They're in our teal book and they're in all the materials that we look at. But you know, I don't think we've ever been at a place where we were setting policy by them. And they're, depending on the rule, it will tell you different things. There are many different formulations. Another way to think about it is implicitly is so. In theory, of course, real rates go up if holding all else equal as inflation comes down. But that doesn't mean we can mechanically adjust policy as real rates, as inflation comes down. It doesn't mean that at all, because for one thing, we don't know. We look at more than just the Fed funds rate. We look at broadly financial conditions. But in addition, we don't know with great confidence where the neutral rate of interest is at any given time. But that also doesn't mean that we wait around for to see the economy turn down, because that would be too late. So we're really in a risk that we move too soon and move too late. And I think to move, which is where almost everyone on the committee is in favor of moving rates down this year. But the timing of that is going to be linked to our gaining confidence that inflation is on a sustainable path down to 2%.
Howard.
Hi, thanks, Chair Bell. I'd like you to key in on the use of the word in the statement that inflation still remains elevated. You've pledged to cut rates before inflation reached 2%. So that implies that there's some sort of intermediate step here on inflation, and that a cut would be consequent with a change in the statement language that inflation remains elevated. What's the step down from there?
Yeah, I don't know that we've worked out the particular statement language and that kind of thing. I would just say, if you look at where 12-month inflation is, and it's still well above core is 2.9%, for example, 12 months, which is way down from where it was. Very, very positive development, very fast decline, and the case is likely that it will continue to come down. So that's where it is. But we're wanting to see more data.
So if I could follow up on that, the statement allows that you want greater confidence on inflation falling before you cut, but it doesn't mention the other side of the mandate, a slide in employment. Would a slide in employment also bring you to the point of
thing we're looking for, but forming in certainly in the labor market, that would certainly weigh on cutting sooner. Absolutely. And if we saw inflation being stickier or higher or those sorts of things would argue for moving later. In the base case, though, where the economy is healthy and we have ongoing growth, solid growth, we have a strong labor market, we have inflation coming down. That's what people are writing their SEP around. And in that case, what we're saying is, based on that, we think we can and should take advantage of that and be careful as we approach that question of when to begin to dial back restriction.
Claire Jones, Financial Times. Just to circle back to the greater confidence aspect of the statement, there's been a lot of unanimity in recent meetings. I'm just wondering, going forward, when it comes to all needing greater confidence, is the unanimity, or at least consensus among FOMC members, about what the threshold for that greater confidence is? And if not, could you maybe tell us a little bit about the discussion today on, what the variations between FOMC members was on what constitutes enough confidence to cut rates, and also if there was any variation on how quickly that greater confidence threshold could be reached? Thank you.
We're not really at that stage. There was no proposal to cut rates. Some people did talk about their view of the rate path. I would point you to the SEP as good evidence of where people are, although it is one cycle later. So, we're not at a place of really working out those kinds of details because we weren't actively considering, a moving the federal funds rate down. I will say there is a wide disparity, a healthy disparity of views, and you see that in public statements, in the minutes, and the transcripts when they're released every 5 years. So we do have a healthy set of differences, and I think that's actually essential for making good policy. We're also able to reach agreement generally because we listen to each other, we compromise, and even though not everybody loves what we do, they're able to, for the most part, able to join in. To me, that's a well-functioning public institution.
Rachel.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. So over the past few years, there have been all these real-time indicators that helped us gain a sharper understanding of where the economy was, like open table data or office attendance. You've talked about vacancies in the past. And I'm wondering at the start of this year, what might be on that dashboard for you that's giving you the clearest picture of the economy, including on rents, if you could touch on that.
Including?
Rent costs.
Yeah. Well, so we're not, it's not the pandemic, so we can actually rely on more traditional forms. People are working, they're getting wages, and the economy is largely reopened and is broadly normalizing, as you see. So I wouldn't say we're looking at that sort of more innovative data as much. You point to rent. So of course, we follow the components of inflation very carefully, which would be goods inflation. I talked about that a little bit. You mentioned housing inflation. So the question is, when will these lower market rents find their way into measured rents as measured in PCE inflation? And we think that's coming, and we know it's coming. It's just a question of when and how big it'll be. So that's in everyone's forecast, I would say. So that will help. But at the same time, we think goods inflation will probably, it's been giving a lot of disinflation to the effort, and probably that declines over time, but it may well have some more time to run. The supply chains are not perfectly back to where they were. In addition, it takes time for the healing process to get into prices. So there may be still a tailwind. We'll find out with that. So we look at the things that relate to our mandate very carefully, and as you would imagine.
I guess just as a quick follow-up, do you feel comfortable at this point saying the economy has reached a soft landing, or is that part of looking for more confidence?
No, I wouldn't say we've achieved that, and I think we have a ways to go. Inflation is still, core inflation is still well above target on a 12-month basis. 12 months is our target. Certainly, I'm encouraged, and we're encouraged by the progress, but we're not declaring victory at all at this point. We think we have a ways to go.
Steve.
Its works. So I'm wondering what you could tell me. How do you believe the neutral rate is working? We're telling you right now that growth is stronger. In other words, how much is the economy really being restrained right now by the current funds rate? And how much restraint does it really need additionally if inflation is still coming down?
So I think you do see in the interest sensitive parts of the economy, you do see, for example, housing, you see the effects, you do. Your second question, though, really, I think is important, and that is a lot of this has come through, a lot of the disinflationary process has come through the healing of supply chains and also of the labor market. So you've seen that other set of factors is really different from other cycles and has brought that, working with tighter policy, which has enabled the supply side to recover, I think is that mixture has been behind what has enabled this. So no, we really do think that we're having an effect broadly across the economy. I would point to the interest sensitive parts of the economy as well as spending generally. But it's a joint story. It's a complicated story.
But how much restraint are you actually imparting to the economy, would you say, relative to the neutral rate?
So I think it's of course, that it's not something you can identify with any precision, but a standard approach would be to take the nominal rate, 5.3%, let's say, and subtract a sort of a forward measure of inflation. If you do that, and there are many, many ways to calculate that neutral rate, but that's one I like to do. And you're going to get to something that is materially above mainstream estimates of neutrality, of the neutral rate. You will. But at the same time, you look at the economy and you say, this is an economy that grew 3.1% last year. And you say, what does that tell you about the neutral rate? What's happening though is the supply side has been recovering in the middle of this. So that won't go on forever. So a lot of the growth we're seeing it isn't just a tug of war between interest rates and demand. You're getting, more activity because of labor market healing and supply chains healing. So I think the question is, when that peters out, I think the restriction will show up probably more sharply.
Rich.
Thank you. Sorry. Thanks for taking the question, Mr. Chairman.
What he just said was a bit weird, I guess. But once the COVID constraints or the issues with COVID in the supply chain evens out, then the higher interest rates are going to start showing. And is that Delulu, or does he know something that we don't have access to? Like, okay, because I feel like the COVID thing is a bit, was a bit pumped up in a way of it was a bit artificial inflation, but then it stuck, or people still had jobs and people still had money, so it continued to stick. We are used to a different level now. So to me, I don't know how artificial that constraint really was or is.
You mentioned earlier we're not seeking a weaker labor market. I think that you said. Can you talk a little bit more about that? Do you think the labor market now is back to quote unquote normal, and that we can achieve the inflation target without wage gains coming back down to what they were pre-pandemic? Even with today's ECI levels, they were still above those pre-pandemic levels.
I think the labor market by many measures is at or nearing normal, but not totally back to normal. And you pointed to one or more of them. So I think, job openings are not quite back to where they were. Wage increases rather are not quite back to where they would need to be in the longer run. I would look at it this way though. The economy is broadly normalizing, and so is the labor market. And that process will probably take some time. So wage setting is something that happens. It's probably will take a couple of years to get all the way back, and that's okay. That's okay. But we do see. You saw today's ECI reading. The evidence is that that wage increases are still at a healthy level, very healthy level, but they're gradually moving back to levels that would be more associated, given assumptions about productivity, are more typically associated with 2% inflation. It's an ongoing process, a healthy one, and I think we're moving in the right direction.
So that process can continue without a weakening of the labor market, basically, you're saying?
Well, I think the labor market is, I don't know if it's rebalancing. Clearly, there was a fairly severe imbalance between demand for workers and supply at the beginning of the pandemic. So we lost several million workers at the beginning of the pandemic from people dropping out of the labor force. And then when the economy reopened, you remember 2021, you had a severe labor shortage, and it was everywhere. The panic on the part of businesses couldn't find people. So what's happened is we expected the labor market to come back quickly, and it didn't. And 2022 was a disappointing year. And, we were kind of thinking, well, maybe we won't get it back. And then 2023, we did, as you know. So labor force participation came back strongly in 23, and so did immigration. Immigration came to a halt during the pandemic. So those two forces have significantly lowered the temperature in the labor market to what is still a very strong labor market. It's still a good labor market for wages and for finding a job, but it's getting back into balance. And that's what we want to see. And one great way to look at that is what's happening with wage increases. And you see it now across the major things that we track. It isn't every quarter, but overall, there's a clear trend, still at high levels, but back down to what would be consistent with where we were before the pandemic and with 2% inflation.
Chris.
Hi, Chris Rugaber at Associated Press. Thank you. you suggested that you're not worried about faster growth so much. So wanted to see if you're seeing anything that suggests that inflation could reaccelerate from here. And it sounds like you're saying you're not worried that solid growth from here on out poses any risk to inflation. Thank you.
No, I think that is a risk, the risk that inflation would reaccelerate. I think the greater risk is that it would stabilize at a level meaningfully above 2%. That's to me more likely. Of course, if inflation were to surprise by moving back up, we would have to respond to that, and that would be a surprise at this point. But I have to tell you, that's why we keep our options open here, and why we're not rushing. So I think both of those are risks, but I think the more likely risk is the one that I mentioned, which is you've had 6 good months, very good months, but what's really going to shake out here? What will, when we look back, what will we see? Will inflation have dipped and then come back up? Are the last 6 months flattered by factors that are one-off factors that won't repeat themselves? We don't think so. We don't. That's not what we think. But that's the question we are asking. We have to ask, and we want to get comfort on that.
And just one quick follow-up. Governor Waller had mentioned the revisions that are coming on February 9th for the CPI data. Is that something you're watching as well? And if we see those revisions fairly minor, is that going to give you more confidence where things are going?
We'll just have to see. Yeah, we'll look at those. Last year was a surprise.
Michael McKee, Bloomberg Radio and Television. If you don't want to use the term soft landing, would you say at least that from your point of view now, the other scenario of a hard landing caused by the Fed is off the table, or the risks have diminished very much? And you mentioned below 2% inflation on a 3-month basis. Core PCE has been running maintained below your.
So your first question, how to describe?
Ask your question in one sentence, crying out loud, mate.
Where we are. So I guess I would just say this. Executive summary would be that growth is solid to strong over the course of last year. The labor market, 3.7% unemployment, indicates that the labor market is strong. We've had just about 2 years now of unemployment under 4%. That hasn't happened in 50 years. So it's a good labor market. And we've seen inflation come down. We've talked about that. So we've got 6 months of good inflation data and an expectation that there's more to come. So this is a good situation. Let's be honest. This is a good economy. But what's the outlook? That's looking in the review. The outlook, we do expect growth to moderate. Of course, we have expected it for some time, and it hasn't happened. But we do expect that it will moderate as supply chain and labor market normalization runs its course. The labor market is rebalancing, as I mentioned. Job creation has slowed. The base of job growth has narrowed. And of course, 12-month inflation is above target and getting down closer to target. It's not guaranteed, but we do seem to be getting on track for that. So those are the risks and questions we have to answer. But overall, this is a pretty good picture. It is a good picture. Your second question was, sorry.
Could you get inflation that is below target, end up with inflation below target, and you have to do something about that?
So the thing is, we're not looking for inflation to tap the.
What kind of question is that? Like, oh, what happens if it goes below target? Like, what do? You cut your rates to 0. Like, did Bloomberg put their best journalist on? I'm pro journalism, but jeez.
The 2% base once. We're looking for it to settle out over time at 2%. And the same thing is true. If we have a month or two of lower, and we have that now, of inflation that's annualized at a lower level, that wouldn't be good. We're not looking to have inflation anchor below 2%. We're looking to have it anchor at 2%. So if we do face those circumstances, then we'll have to deal with that. I think as of now, the question we want to take advantage of this situation and finish the job on inflation while keeping the labor market strong.
as I've heard from some district Fed presidents, is it, in your view, a little premature to think that rate cuts are right around the corner? And then when we do see that first rate cut, should we interpret that as the beginning of a rate cut cycle, or is it a one-off?
So I'll point to that language on your first question. We
Are they running out of questions? Like, are they just asking him now just to ask a question? Like, what is that a question even? Is this going to be a rate? Is this going to be one off, or is this going to be a rate cut? The average last time they had a discussion was 3 rate cuts among the board members. 3 cuts for 2024 was the average. So, is that a series or is it a single off? I don't know. You ask yourself.
included that language in the statement to signal clearly that with strong growth, strong labor market, inflation coming down, the committee intends to move.
We're getting moves
as we consider when to begin to dial back the restrictive stance that we have in place. So if you take that to the current context, we're going to be data dependent. We're going to be looking at this meeting by meeting. Based on the meeting today, I would tell you that I don't think it's likely that the committee will reach a level of confidence by the time of the March meeting to identify March as the time to do that. But that's to be seen. So I wouldn't call it.
Oh, he just flat out said, nope, it's not happening in March.
I'm hearing that as March, base case. Then your second question is
is this the start of when we see a cut, is it the start of a cutting cycle, or could it just be a one-off?
All right.
That's going to depend on the data.
The dog is
the whole
out.
Thing is, this is going to depend on the data. We're going to be looking at the economic
dollar strong
as it affects the outlook and the balance of risks, and we're going to make our decisions based on that. And it could wind up, we'll have another SEP at the March meeting, and people will write down what they think. But in the end, it's really going to depend on how the economy evolves. We talked about there are risks that would cause us to go slower. For example, stronger inflation, more persistent inflation. There are risks that would cause us to, or if they happened, that would cause us to go faster and sooner, and that would be a weakening in the labor market, or for that matter, very, very persuasive, lower inflation. Those are the kinds of things. So we're just going to be reacting to the data. That's really the only way we can do this.
Victoria.
Hi, Victoria Guido with Politico. Could you talk a little bit more about productivity growth? You've mentioned multiple times about, the level of wage growth that's consistent with 2% inflation. We've obviously seen, do you see that productivity as sort of over time?
Activity didn't decline as fast. And then you saw a deep trough of productivity. And then over the last, you saw high productivity last year in 23. I think we're basically in the throes of getting through the pandemic economy. And the question will be, what is it that has changed? The productivity tends to be based on, fundamental aspects of our economy. Is there a case, will it be the case that we come out of this more productive, more on a sustained basis? And I don't know. What would it take? It would take, people talk about AI, but my guess is from home, does intelligence, generative, the productivity is kind of what falls out of the, that's one way to look at it. Yeah.
Nancy.
Hi, Chair Powell, Nancy Marshall-Genzer with Marketplace. I want to ask a little bit more about housing. I'm wondering, as you expected?
Our statutory goals are maximum employment rates at the beginning of the pandemic. For example, we have a built-up set of cities, and people are moving further and further out. So there hasn't been enough housing built, and these are not things that we have any tools to address. But where it comes into play very specifically in our work is inflation, which is a combination. It's really rental inflation. You're taking owner's equivalent rent and then actual rent paid by tenants, and you're running that through the CPI calculation or the PCE calculation, the one we look at. And what that's telling you is that market rents are increasing at a much lower rate, or even being flat, and that will show up in inflation over time. It has to, as long as that remains the case. So
And just real quick, what is your response to the letter that was sent to you by some members of Congress asking the Fed to lower interest rates to make housing more affordable?
My response is what I started with, which is that our job, the job Congress has given us, is price stability and maximum employment. Price stability is absolutely essential for people's lives, most importantly not most importantly, mostly for people at the lower end of the income spectrum who are living at the edges, at the margins. And so for someone like that, high inflation about in the necessities of life, right away you're in trouble. Whereas even middle class people have some scope to absorb higher costs. So we have to it's our job. It's what society has asked us to do, is to get inflation down. And the tools that we use to do it are interest rates. So that's how we think about that.
Courtney.
Courtney Brown from Axios. Can you give us some insight into whether the committee discussed the possibility of slowing balance sheet runoff in the months ahead?
Yes.
Currently 17 pips in profit.
I would start by saying that balance sheet runoff so far has gone very well. And as the process has continued, we're getting to that time where questions are beginning to come into greater focus about the pace of runoff and all that. So at this meeting, we did have some discussion of the balance sheet, and we're planning to begin in-depth discussions of balance sheet issues at our next meeting in March. So those questions are all coming into scope now, and we're focusing on them, but we're at the beginning of that process, I would say.
Quick follow-up. Is it the case that the Fed would decide to lower rates and make adjustments to the balance sheet runoff in tandem?
Yes, I would just say this. Executive summary would be that growth, the labor market is strong. We've had just about 2 years now of unemployment under 4%. That hasn't happened in 6 months of good inflation data. And let's be honest, this is a good economy. But what's the outlook? That's looking in the review. The outlook, we do expect growth to moderate. Of course, we have expected it for some time, and it hasn't happened. But we do expect that it will moderate as supply chain and labor market normalization runs its course. The labor market is rebalancing, as I mentioned. Job creation has slowed. The base inflation is above target and getting on track for that. So those are the risks and questions we have to answer. But overall, this is a pretty good picture. It is a good picture. Your second question was, sorry.
Could you get inflation that is below target, end up with inflation below target, and you have to do something about that?
So the thing is, we're not looking for inflation to tap the 2% base once. We're looking for it to settle out over time at 2%. And the same thing is true. If we have a month or two of lower, and we have that now, of inflation that's annualized at a lower level, that wouldn't be good. We're not looking to have inflation anchor below 2%. We're looking to have it anchor at 2%. So if we do face those circumstances, then we'll have to deal with that. I think as of now, the question, we want to take advantage of this situation and finish the job on inflation while keeping the labor market strong.
Edward.
Edward Lawrence from Fox Business. Thank you, Mr. Chairman, for taking this. So as I've heard from some district Fed presidents, is it, in your view, a little premature to think that rate cuts are right around the corner? And then when we do see that first rate cut, should we interpret that as the beginning of a rate cut cycle, or is it a one-off?
So I'll point you to that language on your first question. We included that language in the statement to signal clearly that with strong growth, strong labor market, inflation coming down, the committee intends to move carefully as we consider when to begin to dial back the restrictive stance that we have in place. So if you take that to the current context, we're going to be data dependent. We're going to be looking at this meeting by meeting. Based on the meeting today, I would tell you that I don't think it's likely that the committee will reach a level of confidence by the time of the March meeting to identify March as the time to do that. But that's to be seen. So I wouldn't call, when you ask me about in the near term, I'm hearing that as March. I would say I don't think it's probably not the most likely case or what we would call the base case. Then your second question is
On the, is this the start of when we see a cut, is it the start of a cutting cycle, or is
Forecast and that the median is for 3 rate cuts this year.
I just dial back and try to find where he said it, and it's very subtle. And I'm just going to use that as an opportunity, people, to like show you what a press conference really has to do. Like that sentence there, like it was a second question, it was in the follow up, and he was he was clarifying his own statement, which is outside of the statements that I just provided like 30 minutes, 45 minutes ago, 1 hour ago, sorry. And he said that it is when you ask about near term, and you see it as in March, it is not likely, and that's what spikes the market. Like it's that forward guidance is a bit of a subtle one, but when there's no cut in March, meaning dollar to the moon, absolutely on tough. Will NFP affect the bears? NFP is a different animal. NFP is becoming less and less important because it is just around the same anyways. Though it has come down. The average is around 165,000. It's a bit lower than previously, but still it's not that important anymore as of inflation. Inflation can make or break the entire dollar trend. All right. So yeah, but yeah, I'm sorry, Dexter. I didn't tell you guys that I did rewind to find it, but now I heard it. Now I can go back to current. But yes, it's a bit long, and some of these questions have been repetitive. I did annoy myself at that question that was asked, but that was actually a question we should have listened to, or the answer at least. And I don't know why we jumped over it or how we jumped over it. Maybe it's my bad, but still, anyways, that's the difference. That can be the difference sometimes in press conference with Powell. It's that sentence, and that was around 9 my times. That is like 30 minutes plus into the press conference. That's where the bombshell drops.
What happens if inflation stays where it's been over the last 6 months for the next 6 months?
So we'll update our inflation forecasts at the next meeting. You referred to the December meeting. That's 3 months old, so it might be lower now given the data we've gotten. So look, as I mentioned, we're going to be reacting to the data. If we get very strong inflation data and it kicks back up, then we'll go slower or later or both. If we got really good inflation data soon, that would matter for both that would tell us that we could go sooner and perhaps go faster. So we're just going to be but of course we'll weigh that with all the other factors. We're setting policy based on the totality of the data.
But just to follow, if inflation stays where it is currently, that would probably mean that the real interest rate becomes more restrictive. Would that mean you'd have to trim more, perhaps, than you already have factored in?
Well, I think if we came to the view that that the 6-month inflation numbers, which are very close to 2, were in PCE world, if we thought that is really where we're going to be, then yes, our policy would be in a different place. It would. But that's the whole point, is we're trying to get comfortable and gain confidence that inflation is on a sustainable path down to 2% or toward 2%.
Daniel.
Hi, Chair Powell. Daniel Avis, Agence France Presse. I just wondered if I could get your comment on the recent consumer confidence data. It seems to suggest that consumers are sort of moving towards a much more optimistic view of the economy. I just wonder, is it fair to say that they're moving towards where the Fed appears to have been in recent months? And do you think that inflation and falling inflation perhaps has played a role in that? And what challenges do you see going forward? Thank you.
Yeah, so it's been interesting that confidence surveys have been weak at a time when unemployment has been low, very low, historically low for a couple of years. But nonetheless, that's been the case. And we've asked ourselves why that is. And one obvious answer, we don't pretend to have perfect wisdom on this, but one obvious answer is that the price level is high. So prices went up much more than 2% per year for a couple of years. And people are going to the store and they're paying much more for the basics of life than they were 2 years ago, 3 years ago, and they're not happy about it. And it's fine that inflation's coming down, but the prices they're paying are still high. So that is what that has to be some part why people are unhappy, and they're right to be unhappy. You know, this is why we need to keep price stability. It's why we need to do our jobs, is so that people don't have to deal with things like this. In terms of you're right. In recent surveys, you've seen a couple of significant increases in consumer confidence or happiness with the economy. I guess that's a good thing. That can support spending, can support economic activity. There's some evidence of that. But you're right, it is a fact that we have seen a meaningful increase. I think levels of confidence are still maybe not as high as they've been at various times, but they certainly have come up.
Like a garment.
Thank you for taking our questions. Brian Menace, CNN Business. Committee members have said they'd like to meet with business leaders and stakeholders in person to learn more about the economy in real time, given that some data are subject to large revisions, the issue of seasonal adjustments being thrown off balance, and many readings of the economy being quarterly. So did any members say they've learned anything not yet reflected in the data, or have you yourself learned anything through anecdotal evidence that hasn't been captured in the data yet?
Well, yes, I'm a big believer that yes. So we do meet with outside groups who come from all different parts of the economy. And I always feel like I spent most of my life in the private sector looking at individual management teams, and then building out from that. And so starting with GDP data and working into what's actually affecting people's lives is challenging. It's very hard. So I really like anecdotal data. In addition, as you know, the 12 reserve banks have really the best network of anyone, that in all their districts, they're talking.
Like, doesn't this journalist know that they base whatever their policy is on a bunch of surveys of these, in particularly businesses, like PMIs and stuff like that? They literally ask, businesses, and each individual of these Federal Reserve banks have business leaders in the committees.
Talking to, not just the business community, but the educational, medical, all nonprofit community. They have arms into all of that. And so when they come back, that's what goes into the beige book. But that they come back, and what each Reserve Bank president does is, during the Outlook go-around, they'll say, in my district, and they'll talk about 100 conversations. They won't talk up. They will give you input based on 100 conversations that they've had with people of all different walks. And I personally find it very helpful in understanding what's going on. And also, I think you hear things before they show up in the data sometimes.
Did any of them notice slowing economy based on what they've heard from their district?
Yes, I mean, if you look back at the last, not this beige book, but the one before, there was a lot of slower activity. I think that what you're hearing now is things are picking up a bit. You're hearing not in every district, and not every person that we talk to, but you're overall, it feels like you're hearing things picking up at the margin. So that's what.
Thank you, sir. Jeff Cox from CNBC.com. Just kind of looking to put it all together. You talked about basically the economy looking strong with 3.3% annualized growth in the fourth quarter. Does the strength of the economy speak more loudly to you now than any inflation threat might? That you're in a position you're more tilted that inflation could come back at some point.
I'm not so worried about that. It's again, we've had inflation come down without a slow economy and without important increases in unemployment, and there's no reason why we should want to get in the way of that process if it's going to continue. So I think declining inflation, continued declines in inflation are really the main thing we're looking at. Of course, we want the labor market to remain strong too. We don't have a growth mandate. We've got a maximum employment mandate and a price stability mandate. And those are the two things we look at. Growth only matters to the extent it influences our achievement of those two mandates. Thank you very much.
All right. Well, actually, I was a bit bored in mid press conference. I didn't think it would come out of it. He was like, well, whatever. And there he goes, gives off a bombshell, slightly at least, that there's nothing in March. Well, shock, or it might be slightly premature if the CPI comes out horribly lower. But of course, at least sets the stage for dollar strength. I've been asked questions about gold, on dollar yen. It's dollar strength. It is dollar strength. Yen's going to be higher. Dollar pairs are going to go lower. Dollar CAD is going to go higher. That's at least the reaction. Is it going to continue that way? Well, that depends on seasonality and technicalities and demand and a lot of other factors. That's not necessarily indicative of, oh, now we're going to go higher in dollar, but short-term wise for today doesn't speak dollar bearish. Yeah, that's the fun part. In Dexter, we fell, and I think tomorrow we're going to break it, to be honest. We'll have NFP tomorrow. That's just volatility. So I don't know if people are going to break tomorrow with NFP as a catalyst, because they don't want to put on too many hopes or anything in either direction and then use that as a volatility to get a better price and then smack the market. Joe, what's your comments?
Well, after what
Summary.
Powell said, the yield spreads went down. I mean, I'm having deja vu because one of the first
meeting?
things I said. Hello?
Yeah, which meeting?
No, this meeting. One of the first things I said when I hopped on the stream today was that the magnitude of this move, just based off the FOMC statement, because it was the most neutral of neutral statements, and that if in the statement they had made any comments about when they were going to hike or cut, or if they gave a time frame instead of staying data dependent, that it would have had a much immediate magnitude move across assets, especially on the dollar. And now Powell, during his speech, comes out and actually gives that time frame, and immediately the magnitude, the volatility starts to hit, the moves start happening. So, I mean, look, if you understand what you're doing and you understand the expectations of traders and how expectations change over time and why people have certain expectations for a market, it's very easy to trade.
I have no problems here. I'm pretty settled.
I mean, I saw that the yield spreads were getting pretty darn negative on. I look at yield spreads across all the dollar pairs, and I saw Australia had probably the worst ones. Yield spreads on New Zealand are actually still quite positive, and you'll see that one has about half the drawdown of all these other pairs. It's got about 25 pips of drawdown. Aussie dollars at roughly 40, Euro dollars at roughly 40. So New Zealand dollar is holding in there. Actually, that would have been a good trade on the cross for Aussie New Zealand, getting long New Zealand on the Aussie New Zealand cross. Actually, now that I look at it on my chart, that looks pretty all right, if I do say so, as far as finding a weekly low. Again, we're at the end of the month, so it's a matter of coming up with expectations for the rest of the month, forecasts, probabilities, seasonality. I have a feeling that the seasonality metrics are not going to line up with the realized values over the rest of this week and probably next week, or at least the first, half of next week. I don't think that the seasonality is going to be particularly correlated with the moves that we're going to be experiencing throughout probably the first little bit here of unless the seasonality is dollar strength, I'd be quite skeptical Because now that we actually have this thing out of Powell saying, "Oh yeah, we're definitely not doing March. It's not our base case scenario." Everything just got moved over to May. All the future rate probabilities got moved over to May. Maybe once we get to the March, March, and now we have to wait all of February, March, April, and then we have like 3.5 months till that May meeting. So the March meeting is dead on arrival because you're only getting two more CPI reports, and that's probably not going to be enough for the Fed to move unless there's like this outsized volatile CPI move lower for that disinflation. But if you get too big of a move lower in US CPI, that's
going to run it.
Really short term could make the dollar super strong on that release. But then again, the future expectation for rate cuts accelerates on big disinflationary surprises. So you're going to have a huge increase in volatility because on the release of that surprise disinflationary CPI, you'll end up with people who are like, oh, this affects me right now. I need to be buying dollars because this inflation numbers, the inflation is disinflating right now. This is actually a problem for me. I need to have dollars here in case there's more disinflation. And the people who are looking out a month or two, who are looking at their needs, not right now, but in a month or two, are saying, well, because disinflation is significant right now, I actually need to be buying dollars because there's a rate cut coming down the line here. So you're going to end up with a much more significant amount of volatility if we do get an acceleration in disinflation over the next two prints. Now, that's not the base case scenario, and that's what we heard from Powell. That's the base case scenario, is you have essentially a fairly linear decrease because most of the inflation is coming from the services side. The goods side is disinflating at a nominal pace. It is moving lower, but you're not going to be able to get to the 2% inflation target that the Fed wants just on goods alone. He specifically said, at that point, services has to give. And I don't know if services is going to give. You just don't know. And if that's the case, we might not see the hike in May if services inflation doesn't give. And that's kind of a far out call. I'm not so sure about that situation. But when it comes down to right now, the next week and a half, it's probably going to be definitively on the dollar's trend of things right now. The yields are pretty definitively in favor of dollar right now across the board on the FX side of things. All the yield spreads, if you look at the difference from 10-year yields versus in Australia versus the United States or Europe versus the United States, the yields are moving so significantly in favor of the US dollar. The yields are a huge driver. They've been a known driver of FX prices for like the last 40 years. They're probably just as important, if not a little bit more than seasonality. Because as in real time the yields change, the price on the FX spot can change. But the seasonality can give us such a good view of nominal expectations if we follow seasonal expectations. There's always the assumption of seasonal data that your data is behaving seasonally, right? So it always has to be tempered with, do I have actual seasonal expectations? Is that assumption being met? And I'd say, well, maybe for the next week and a half, that assumption's definitely going to be challenged, if not a bit rocky. But I'd say once you start getting out into May, between the latter half of February and May, the seasonal expectations might hold up a bit more significantly, especially against the dollar. Like once you get between the March FOMC and the May FOMC, the seasonality might be a more significant factor. Or in this period, like in the latter half of February, in the beginning of March, there might, like the last 2 weeks of February and the first 2 weeks of March might have more significant seasonality correlation on the realized front. So I'm just skeptical on the seasonality getting realized because of what happened today with FOMC. Because generally speaking, this, don't get me wrong, usually dollar gets stronger on FOMC days, right? But this decision can have consequences that lead to a trend and momentum of dollar strength, not just like, okay, the rest of this week and part of next week is strength, which is still my baseline. But this can have a consequence where it's like, okay, if other central banks are cutting behind this and the dollar and the FOMC is still on hold, the relative rate of change is actually for US yields, the spread between US yields and G7, G10, 10-year, 5-year yields to get wider in favor of the United States. And that's just going to be an even bigger driver of US dollar buying. So there's a slippery slope here that
That's
we
the
will
fun
be
part.
informed of by the middle of February on whether or not that slippery slope comes across our door.
Yeah. Your dollar going lower at the moment. Dollar currently rising as kind of expected before the meeting, helped by Powell. If we get central bank divergence, which it's pretty likely at the moment, with again recession in Germany, Europe not performing, Australia starting to struggle. Oh, are also struggling. I have, well, what was it last time in England? England's gonna have a meeting tomorrow. I remember last time they pushed back on the rate cuts thesis. So if that's also gonna be a slippery slope on the downside. It's gonna be a fun little downside, I would say. So what about other central banks? I would argue that they are on the slope to rate cut. And if America now currently stands still as they are, it's going to be an even easier trade, and even more fun, divergence, because that's going to just make the trade even faster, even funnier. But yeah, base case going forward, dollar strength the next week. Going forward, I am a bit worried about tomorrow. I was worried today, a bit earlier in the stream, about having a deep pullback and then sell off on Monday. I haven't gotten that yet, so that's all. S&P 500 was at the peak of at the target of a monthly target and weekly. So this is easy piece lemon squeezy going lower. This is going to go low forever. It's just going to go lower now because it also has risen a lot. So it's kind of like a buying case for me still, just not now, just not there. I probably will miss the bottom anyways. But what generally tends to happen going into an FOMC meeting is that price rises going in and then falls. But yeah, that's at least the normality. And it's a pulling back, highly welcomed, highly anticipated, highly expected. And if you didn't do that, then you need to do better research next time. Anything else? Yen pairs, I don't know. was supposed to be bearish on yen pairs, but currently falling today. It goes opposite of dollars if dollar strengthens, this one weakens. So right now it's a bit of a brain twist here. But yeah, looking for pullbacks on dollar CAD, New Zealand dollar, pound dollar, euro dollar, Australian dollar. Most of them are in a range, hasn't broken yet. So we still need NFP tomorrow to help us out. Thank you for joining, Joe. Highly highly appreciate it. To the rest of you guys, thank you guys for joining in, and I'll see you tomorrow.
Thank you very much, Ivan.